In this week's video, we'll review the latest charts to help us answer the question, will the highest inflation in 30 years derail the year-end rally in stocks? And to answer that question, we'll be answering three sub-questions. Question number one, is the market shifting into risk-off mode? Question number two, how concerning is a recent rare overbought reading? And question number three, are institutions preparing for long-term inflation? Starting with question number one, does it look like this week's inflation report is going to derail the bull market in stocks? To help us answer that question, let's look at TLT relative to SPY, bonds relative to stocks, consumer staples, XLP relative to SPY, the S&P 500, and the VIX Fear Index relative to the S&P 500. These are monthly charts. We'll begin in 2005. This is where the S&P 500 peaked in October of 2007. The same can be said for this point here and this point here. Notice in all three cases, we can see these ratios start to rise rapidly. We can even call this a spike. This is early in 2007. The S&P 500 doesn't peak until October. This looks like about mid-2007, several months before the S&P 500 peaked. And we have an increasing fear look here. Looks like late in Q2 of 2007, TLT relative to SPY started to outperform significantly before the S&P 500 peaked. Thus, in the present day, if fear were increasing, we would expect to see something like this here, something like this here, and or something like this here. If we fast forward to November of 2021, that's not what we have. Notice we're making new highs over here, new highs over here, new highs over here. Instead, we're making new lows, new multi-month lows, and recently made a new multi-year low. Thus, compare and contrast the look of increasing fear to the present day, the look of increasing fear to the present day, and the look of increasing fear to the present day. But Chris, things can change very, very quickly. That's true, but we trade the chart in front of us. These charts may change very, very soon, but they haven't changed yet. Had a question from a client this week. Chris, how concerning is a recent rare overbought reading in daily RSI on the S&P 500 index? More specifically, recently daily RSI, right side of the screen, S&P 500 hit 76.71. And if we look at a chart going back to late 2017 on the left side of your screen, you can see it's only happened a handful of times looking back approximately 4 years. And you also might have noticed that in the last 4 years, when something similar happened, this is about a 10% correction here in the S&P 500. This is the COVID plunge right here where my cursor's moving around. And this is the early stages of a period of consolidation that lasted several weeks or months in here. So back to the original question, how concerning is this? First, let's look at performance in the cases that we just covered in terms of what happened next in the S&P 500. We hit a similar reading 2018, late 2019, and in August of 2020. And if we walked forward in the S&P 500 from the date of the signal, you can see it's probably fair to say that this signal contradicts rather than aligns with the bullish thesis, as well as the thesis that we should be open to the S&P 500 performing fairly well between now and year end. So to get back to the how concerning, probably fair to say we've just proven that it's concerning. So to dig a little deeper, let's ask the same question in this period, S&P 500 1995 until the peak in the spring of 2000, upper right-hand corner of your screen. Might be helpful to know, how many times did we see a similar daily RSI reading between point A and point B? The answer is several times. Also might be helpful to know, over the period that we just covered, subsequent S&P performance was pretty concerning. How about over The second period, 1995 to the spring of 2000. Number one, it doesn't look as rare as the previous period. And number two, in terms of how concerning, I think it's fair to say, over this period, not only was it not concerning, it was relatively bullish. In every single case, the S&P 500 was higher 9 months later. The average gain almost 17%, the median gain a hair over 19%. 1 year later, even a little better, average gain almost 24%. If we round up, the median gain sitting right around 22.5-ish. After the stock market moves a long way, as it did from this point here in Q4 of 2018 to early 2020, sometimes an overbought reading can be just that the market's due for some type of pullback. But getting over RSI 70, as we all know, is also a sign of strength. That's difficult to do. And in other cases, when the S&P 500 starts to rally and RSI hits similar, quote-unquote, overbought levels, really good things can happen in the stock market. Notice in these 1995 cases, look how much green we have here at the top of the table. Simply telling us to keep an open mind about better than expected outcomes, and that a relatively rare reading on daily RSI doesn't necessarily mean the bull is in trouble. Also noteworthy, this is 2017 to 2021. Something similar happened early in 1995. Thus, we have something that happened recently that ties the present day back to 1995. In fact, we hit a similar reading 1, 2, 3, 4, 5, 6 times in calendar year 1995. You might remember in last week's video, we had something that just happened in 2021 that was similar to 1995. Outcomes very favorable in these historical cases. Here's another data point here. November 8th ties the present day to 1995. Way back in July of this year, 1995 once again showed up something similar that happened in 2021. And in the September 17th video, we said the trend in the present day was similar to the trend in 1995. And in these historical cases that featured similar strong trends in the S&P 500, 541 calendar days after a low, you can see here really, really good things happen looking out 2 to 5 years. Clients and regular viewers know we've talked about 1995 a lot. In fact, if we went and counted the number of references or signals that we've seen in 2021, it would be much higher probably than the ones that we just covered. That was just a handful. Covered this chart in the past as well. This is the 4-year period here, 2017 to the present day. Look at the look here of the equity put call ratio. This is the 10-day moving average on a monthly chart. Compare and contrast the look here to the look here. And if we were to say, does this period in here where RSI signaled concerning things, does this look more like the present day, or does the mid to late 1990s look more like the present day? This look here, the break from this box, is telling us any comparisons that we have looking backwards here may need to be taken with a grain of salt, since we're now potentially in a secular trend. Let's move to question number 2. Are institutions preparing for long-term inflation? So, Bloomberg article dated November 11th, 2021. Value shares, digital currencies, gold, and bets on a flatter yield curve are seen as some of the potential beneficiaries from a higher inflation environment. If we pull some text out of this article and separate it into these 3 bullet points on your screen, and then shift over to a Cliff Notes version, and then reduce that even further, the main takeaways are, in an inflationary environment, value shares, gold, financials, materials, energy tend to do well. These are things you would want to own using this playbook. And on the other side of the coin, things that you would want to avoid or things that you would expect to underperform. Sectors such as technology, consumer discretionary, You really don't want to be in growth relative to value. There's a quote in the article that says the ultimate inflation hedge is value stocks. And we all know the market's been talking about inflation for well over a year now, so there's been plenty of time to reposition portfolios using this playbook if market participants believe that inflation is here to stay relative to the long term. And maybe more importantly, if market participants believe the Fed has let inflation get out of control. So really what we're asking here, this is a narrative, this is a playbook. Do the charts in front of us align with the narrative or contradict the narrative? So let's start by taking a look at value stocks relative to growth stocks. It's a daily chart of SCHG relative to VTV. That's growth stocks in the ETF world relative to value stocks. This is the beginning of 2020 here. This is the 200-day moving average in red. You can see in May, aligning perfectly with the script, for several months looking backwards, value had significantly outperformed growth. And the expectation was from a lot of circles that that would continue. But if we start to walk forward from this point in May of this year, we can see the chart in front of us is starting to drift from the inflation playbook or the inflation script. If market participants were concerned that the Fed has lost control of inflation, we really wouldn't expect to see growth outperforming value for 1, 2, 3, 4, 5+ months in here. The growth value ratio has been making recently a series of higher highs and a series of higher lows. It's recaptured the 200-day moving average, and it looks like the 200-day moving average flattened out here and is trying to turn back up. The 200-day helps us with the longer-term trend. If we put a 50-day moving average on the chart, it helps us with the intermediate-term trend. You can see here back in May, June, July, the 50-day in blue started to turn back up. Now we have a full-bore bullish look here relative to what we have on the screen. We have price above both moving averages. The slopes of both moving averages are either up or trying to turn back up. Now this is still somewhat of an indecisive look in here, but there's no question the recent trend has been favoring growth over value. And from that November 11th article, we know the script also says you'd rather own value relative to tech. And if market participants were preparing for a situation where they thought the Fed was going to let inflation get out of control, we really wouldn't expect this ratio to be moving from point A here in May to making a higher high, a multi-month high here in the month of November and recapturing that 200-day moving average. And going back to the cliff notes from the article, any shift out of growth is likely to benefit value sectors such as financials, materials, and energy. So energy is one of our positives, and tech is potentially on the negative side of the ledger. So if we compare XLE energy relative to a technology ETF, IYW, if market participants were very, very concerned about longer-term inflation, and they've had a lot of time to think about that topic, we wouldn't expect the chart of energy relative to tech to make a high in June of 2020 and then make a discernible lower high in March of 2021 and then not even be able to make it back to that downward sloping trend line in May and June of this year and then run into a similar situation here. The recent peak couldn't even get back to this downward sloping trend line. Now, there's no question this is consolidation and a form of indecisiveness. But looking back over a year now, we have a downward sloping trend line on the XLE relative to IYW chart. Obviously, a breakout in this direction here would change the look of the chart in front of us. But the chart in front of us has been making a high, a lower high, a lower high, a lower high, and another lower high. It doesn't seem like a market that's wildly concerned about long-term inflation. So remember, before we go to the next set of charts, if you're boxed in green, those are the things you would want to own relative to the script, and if you're boxed in red, those are the things we would want to avoid, or those are the things that we would expect to underperform. And we know the ultimate inflation hedge is value stocks. From a very long-term perspective, think about how long we've been talking about inflation. This is the long-term trend in value relative to growth on the left side of your screen. It's a monthly chart going back to 2007. Even on a small chart like this is the recent trend. We've been making lower lows here in recent months, and here looks like we hit a high and then we've kind of stalled in here. Similar situation relative to energy versus growth. With all the talk about inflation, you really would expect a little bit more progress on this chart. And again, in each case, no question, we've got consolidation, consolidation, and consolidation. So all three of these charts use growth as the denominator. In this case, let's look at tech. So value versus tech, clearly in a long-term downtrend. Financials versus tech, clearly in a long-term downtrend. And energy versus tech remains in a long-term downtrend. In recent months, the ratio has been going lower, not higher, lower here, not higher, lower here, not higher, and in each case, we're below a downward sloping 50-month moving average shown in blue. And if we just look at price, in each case, the ratio is still below downward sloping trend lines, and nothing says that these charts can't change significantly and get in line with this script. But we trade the chart in front of us. These charts may change soon, but they haven't changed significantly yet. Similar situation here. Gold is in the green box. Materials in the green box. Discretionary in the red box. Value in the green box. So we would expect gold to outperform growth, materials to outperform tech, and value to outperform discretionary. On a long-term basis, we just don't have that. In fact, gold relative to growth stocks recently made a new low here, recent weakness here, and recent weakness here. All of these charts may change very, very soon to get in line with this script or story, but they haven't changed yet. And it may be fair to ask, why do these charts still look like this? Why has this trend been down for over a year? And why has this ratio been moving higher for several months? Well, only the market knows the answer to that question, but one hypothesis is summarized in this tweet on the right side of your screen. It basically says the Fed's inflation credibility with the market remains intact. Yes, market participants are concerned about rising inflation looking out, say, 1 to 5 years. But when you look out 5 to 10 years, or in a longer-term time horizon, even after the concerning inflation report, expected inflation for the 5 years starting 5 years from now actually dropped after that report. And this tweet here seems to align with these charts, this chart, and the recent move in this ratio. As always, it's incredibly important to note, we're making comments about the chart in front of us. Is it possible that we're going to see something like this very, very soon? We know the answer to that. It's absolutely positively yes. But the chart in front of us has been improving for several months now. And prior to that, the long-term trend on the left side of your screen unequivocally favored growth over value, and the inflation trade charts have a lot of work to do relative to those long-term trends. Not making any assumptions about what these charts will look like tomorrow or over the coming months, but we know definitively what they look like today. And in terms of our first question, is the market shifting into risk-off mode? One of the concerning factors in the stock market is when the availability of credit or access to credit becomes tighter or more constrained. We don't have anything like that today. We have just the opposite. U.S. financial conditions are near the loosest they've been in 4 decades, according to Goldman Sachs, the source being Bloomberg. This doesn't look like credit markets that are concerned about an imminent recession and bear market. It's fair to say this is currently a strong tailwind for stocks. That aligns with the strong demographic tailwind that we covered in a previous video. And after that ugly inflation report earlier this week, might be fair to ask, how much damage have we seen to the trend in 2021? This was the look of the present day chart on October 6th. We covered it in the October 8th video. You might remember this was the type of look or this type of transition that we would want to avoid in the present day. So after that inflation report, how much deterioration do we have on this chart? Well, relative to the looks on the perimeter of this page and relative to the look of the chart on October 6th, things look quite a bit better on a relative basis on November 11th. Chart in front of us still has a full-bore bullish look with blue, the fastest moving average on top, silver, the slowest moving average on the bottom, and all of the slopes are up with price above all of the moving averages. That looks discernibly different from this concerning transition here during the financial crisis, and discernibly different from this concerning transition here when things really started to get ugly in the stock market in Q4 of the year 2000. And this is the look of the present day trend after the ugly inflation number was released. And we all know the only way that we're properly going to use a chart like this, and the only way that we're going to be able to see that this consolidation potentially breaks out in a bullish manner, or if there's a significant change on these charts, and the only way that we're going to be able to use concepts like this properly is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.